Off to the races. California Senator Kamala Harris joins Team Biden. And the S&P 500 falls short of a new record as economic data show an uneven recovery. This is Bloomberg Wall Street Week. I'm Scarlet Fu, in for David Westin. This week, special contributor Larry Summers of Harvard, Accenture CEO Julie Sweet.
It's a first step at a really, truly scaled opportunity.
Council on Foreign Relations President Richard Haass.
In the short run, I'm actually quite worried about a military incident. In the longer run, David, I'm actually concerned about a U.S.-Chinese Cold War.
Moelis & Company Vice Chairman Eric Cantor.
If an investor believes that he or she can benefit from a lower capital gains rates going forward, I think it does prompt more interest in putting capital at risk.
Guggenheim Global CIO Scott Minerd and Traub Senior Managing Director Kelsey Groome. Mixed messages on the economy. Jobless claims dipping below 1 million for the first time since March. Retail sales gain, but the pace is slowing down. Boston Fed President Eric Rosengren says a continued recovery depends on more economic aid.
My personal assumption and my forecast is that some form of additional stimulus is going to occur. It would definitely be bad news both for my forecast and for the economy if we don't do any additional stimulus at this time.
Stocks rise, but the S&P 500 can't cross the finish line on a new high. The real action, though, was the sell-off in treasuries, which sent yields climbing. Investors also have a clearer picture of America's choice in November. Kamala Harris joins Joe Biden as his running mate. Her relatively moderate stances give Wall Street some relief.
Kamala, as you all know, is smart. She's tough. She's experienced. She's a proven fighter for the backbone of this country, the middle class, for all those who are struggling to get into the middle class. Kamala knows how to govern. She knows how to make the hard calls. She's ready to do this job on day one.
Joining us now is Wall Street Week special contributor and former Treasury Secretary Larry Summers. He is also an advisor to presidential candidate Joe Biden. Larry, I want to start with Biden's pick of Kamala Harris as his vice president. The Democratic National Convention, we know, starts next week, and Senator Harris will give her acceptance speech. What does her addition mean for the Biden agenda, especially when it comes to his economic plans?
Let me just say, Scarlet, I'm one of many, many people who has spoken with the vice president about economic policy, but I'm in no sense part of his campaign. As an advisor, and certainly I speak only for myself. I think Senator Harris is someone who has had good relationships with a wide range of people in the economy, with workers and representatives of workers, with corporate leaders, with consumer groups, with other stakeholders in the economy, and I think she's widely respected. I think that she and Senator Biden are determined to govern in a very different way than the economy has been governed for the last 4 years. It's a way that will build on the middle class. It's a way that will be positive about the role of government in protecting people, in redressing inequality, in making necessary public investments. And it's a way that isn't about pitting one group against another group, but that recognizes that we all rise and fall together with the economy. And it's a very interesting fact, and I think one that should get more attention than it sometimes does, Scarlet, that when we've had Democratic administrations historically, corporate profits have risen more rapidly, the stock market has earned higher returns. And that's not because their loyalty has been to corporate interests, but it's been because they've had a better effective economic strategy because it was based on helping the middle class, and in the end, that's what's benefited businesses to a greater degree. So nobody knows what will happen in the election, but in the event that a Biden-Harris team comes to power, my best guess is that you'll see some significant acceleration in economic growth, and that things will benefit the markets as well. You know, people talk about how it's an accomplishment, Scarlet, that somehow unemployment insurance claims are now below 1 million. Never in the post-war history of the United States had they gotten close to 1 million before the last 6 months. Even at the worst of the 2008 recession, they weren't running at nearly the level that they're running even still now. So it is madness that we are not supporting the economy with extensions of unemployment insurance, with support for state and local governments that are being crushed. And certainly a different administration will get to a different place on that.
Well, that's where I want to go next, because the other big headline of the week was what didn't happen, any kind of stimulus deal. How much does Washington's failure on this slow the economy's trajectory?
Millions of people will be unemployed who don't have to. Kids who come out of college will get on lower career trajectories because of the mistakes that we are making. People will die because of the budgets that will be taken away from municipal hospitals. Kids will have their gaining knowledge, have their basic skill in learning to read taken away because we will be inadequately investing in public schools. Our streets will be less safe because we will be inadequately investing in the programs that keep them safe, both the social and emotional programs that help with disadvantaged youth, both the protection, the presence of people who ensure our security. All of that will happen because of stimulus not being passed. We are going to not be the country that we can be. You know, someone said the other day that the United States has been feared, the United States has been admired, the United States has elicited all kinds of reactions. But until these last months, the reaction has never been to pity Americans. And that's the reaction we're having now. And what the stimulus bill would do, invest in healthcare, invest in education, invest in the frontline workers who are keeping us safe, invest in protecting the people who are unemployed and whose children are going hungry. That's what this bill is about. And when people stop it from happening, they are a reason why the United States is pitied. And it's a very sad thing that goes beyond the usual partisan disputes that take place in a presidential election year.
Larry, I have just one question here. Yes or no? Would it take a stock market tumble for Washington to get its act together and catalyze some kind of deal? Yes? No?
It might. It might. And it's a terrible thing that people being hungry doesn't move Washington, but the stock market falling does. What moves you says a lot about your values. And it's something we really need to be concerned about, especially with respect to this administration.
Well, doesn't seem like it's an issue right now, given where we are with the stock market. Special contributor Larry Summers, thank you so much for joining us. Coming up, stimulus stalemate. David Westin asking former House Majority Leader Eric Cantor what to expect from Washington. That's next on Wall Street Week on Bloomberg.
This is Wall Street Week. I'm David Westin. Washington always has some effect on Wall Street, but perhaps never more than when, as this week, Washington promises but cannot quite deliver a big stimulus package. We talked about the consequences for the C-suite with Eric Cantor, someone who's dealt with it both from Washington and from Wall Street, first as House Majority Leader and now as Vice Chairman of Moelis & Company.
What we're seeing at Moelis & Company is actually a pent-up demand for quality assets. And if you've got a quality asset, there is a lot of interest on the part of our corporate clients, our private equity clients, and in many cases, those kind of assets are attracting so much attention that some of the potential buyers are looking to pay even pre-COVID prices for those kind of assets. And when you're talking about assets, you're talking about COVID resistant assets. So obviously assets in the healthcare space, the technology space, the business services space. This is where we're seeing now increasing momentum coming forth and a lot more robust dialogue than we had maybe a month or 6 weeks ago.
How is the very loose monetary policy, if I can characterize that, how is that affecting prices?
Well, I think there's no question that having the loose monetary policy, the consequence of that is clearly in lower interest rates, so the cost of borrowing is going to be lower. Access to capital continues to be good. Even the credit markets, when they were, ailing in the beginning of this, the Fed stepped in, has announced it'll be the backstop. So for the most part, I think you've got a much more healthy kind of environment in terms of access to capital than people originally would have thought when we entered this pandemic.
In order to make an investment make sense, you need to be confident there's going to be demand for the product or service coming up. And that takes us back to the economy, an economy that continues to limp along. It's made some progress back, but I think it's fair to say it's a long way from out of the woods. What do you make of this fight over stimulus right now in Washington? You spent so much time there. You understand these players.
Well, I think, first of all, it is a given that we're not going to see a full return to our economic normalcy until a vaccine arrives. So in the meantime, I think it is incumbent upon the government to address the needs that arise for those who are out of work. I mean, that's first and foremost. And that's why you're seeing a lot of this skirmish take place around the unemployment insurance number. How much is it going to be? I just think we're going to see a prolonged period of time where these what we call automatic stabilizers like unemployment insurance are going to be in place and are going to be elevated for quite some time. And eventually there will be, in my opinion, a deal done in Washington around a relief package. I think it'll be a lot more targeted than perhaps the CARES Act was. Companies on the whole that will be beneficiaries of the continued support will be companies who have suffered disproportionately under the pandemic. It won't be just all companies. I also think that you can't do without some assistance to state and local governments. Number one, they're a large employer in our economy. And I don't think anybody wants to see this massive number of people just dumped onto the unemployment rolls. And that dislocation is going to have to be managed.
President Trump came out and said that he was at least seriously considering, as he put it, unilaterally imposing some sort of relief on capital gains tax. Now, we've heard that, particularly from Republicans through the years. He says it will create a lot more jobs. Does that hold true today, particularly when the interest rates are so low?
Well, I mean, I think, first of all, cap gains and taxation has to do with valuations, too. And with the elevated nature of valuations right now, there are a lot of gains to be had. And if an investor believes that he or she can benefit from a lower capital gains rates going forward, I think it does prompt more interest in putting capital at risk. I've always been a believer in a risk-based system of investment in this country. We're the best there is in the world. So I do think it would be additive. Now, the question's always been in Washington about the president or any executive's authority to actually affect the rate. And I believe the way, we haven't seen a lot of details on this, but I believe the way that the White House or President Trump would go about this would be to provide or impose an indexing ceiling on the capital gains rates, which would then, again, allow for an investor to avoid the inflation impact of an increase in valuation. So, as you say, with rates or inflation so low, perhaps the impact of a move like that will be more muted. It'll still send a signal, though, that risk-based investors should look positively on a development like that.
That was Eric Cantor of Moelis and Company. Coming up, President Trump has been dismantling much of U.S. foreign policy crafted over 70 years. We talk with Richard Haass of the Council on Foreign Relations about what this could mean for the health of the U.S. economy.
We've lost a real chance, I think, to grow global trade and also to improve the way it's regulated.
This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. The United States flourished under a post-World War II regime built on multinational institutions like the IMF and the World Bank. But President Trump has gone in a very different direction, something addressed by Council on Foreign Relations President Richard Haass in his new piece for Foreign Affairs, Present at the Disruption.
When I met with him when he was still a candidate, he believed that fervently, that trade agreements have ripped us off, and that essentially the costs of foreign policy, our stationing of troops overseas and the like, far outweighs any benefits. What he seems to be missing here, David, is that for 75 years, there's not been a great power conflict. To the extent there was a conflict, the Cold War, one, it stayed cold, and two, it ended on terms that were extraordinarily favorable to us.
Richard, even when Donald Trump came to office, things were changing. I mean, China was growing very quickly. It was growing to challenge us as the world's dominant economic power. Was it inevitable that we had to do something other than what was left over after World War II?
Oh, absolutely, for several reasons. One, you point to China has emerged in many ways, and we needed to adjust our policy. And I think the president deserves some credit for calling out China. Where I think he gets the blame is I don't see anything coherent or consistent for dealing with China. Probably an even greater problem with American foreign policy is a lot of the institutions that you referred to are getting long in the tooth. We've got a whole new set of challenges in the world, things like how to regulate cyberspace, what to do about climate change, what to do about proliferation. And we simply don't have the mechanisms in place in the world. There's a real shortfall when it comes to international arrangements. So addressing that has got to be on our agenda. Unfortunately, the president is essentially uninterested or even opposed to international agreements of those sorts.
You mentioned China, obviously a terribly important relationship for the United States, economically as well as geopolitically. Where are we headed right now with China if we keep going the direction we are? The president clearly believes that if he keeps putting enough pressure on China, he will do something good for the United States and good for U.S. workers.
I can see two things happening if we keep going. In the short run, I'm actually quite worried about a military incident, say between American and Chinese aircraft or ships in something like the South China Sea, the Taiwan Straits, near islands also claimed by Japan in the Pacific. And the real challenge then will be to try to put a lid on it so an incident doesn't grow into a conflict. In the longer run, David, I'm actually concerned about a U.S.-Chinese Cold War, an across-the-board competition that at times has us lined up against one another. It's dangerous, it's costly, but also it would probably rule out U.S.-Chinese cooperation, say, in dealing with North Korea or dealing with global health or dealing with climate change. And I think we're pretty far down that road.
So one of the focal points of our relationship with China, certainly under President Trump, has been trade. But the trade issues facing the United States are not limited to China. They go much more broadly, including the very institution of the WTO and our relations with Europe, with a lot of our allies. What is happening to our economy because of what has happened with trade under President Trump?
And we've lost a real chance, I think, to grow global trade and also to improve the way it's regulated. If we'd stayed in the Trans-Pacific Partnership, that would have teamed us up with countries all together. We would have represented over 40% of the world's GDP. We then could have put tremendous pressure on China to raise its game, to meet our standards.
As you know so well, Richard, we've got an election in this country coming up November 3rd, and including for the President of the United States. Exactly. There's a rumor to that effect. But as you look at that possible fork in the road, how do you look at a Biden, now we know Harris administration with respect to foreign policy as opposed to Trump-Pence?
Well, I think the differences would be much more willingness to work with allies. I think that would probably be sort of the foundation. They deal with allies and then approach all these regional and global challenges. I think you'd probably see re-entry into various international arrangements and institutions. The problem for a Biden-Harris administration, or the challenge, would be their inheritance would be rough. It'd be a really daunting inbox. 4 years ago, David, you'll recall I wrote a book called A World in Disarray. Well, now it's disarray on steroids. So I think they would face that all the time. Think about it. The next president and vice president are going to have to still deal with a pandemic here at home, tens of millions unemployed, a country divided by politics and race, possibly by the election itself. So that they're going to have a situation where there'll be greater demand than ever for American leadership and involvement in the world. At the same time, the home front will be calling out for repair.
So, Richard, you deal with these world leaders on a regular basis. Is there a pent-up demand for an alternative to President Trump? I'm reminded of the fact that at the end of George W. Bush's administration, it was thought that our reputation, some people thought, was not very good in the world. And then President Obama came in. Certainly the Obama administration, I think they turned it around pretty quickly. Is that realistic?
Where I think the greatest demand for change and something like a return to what people thought they knew, for the familiar, is with our allies. They treasure American reliability and predictability. Consultations are important. So in Europe and Asia is where you find the greatest demand for something familiar. But I would think in countries like Turkey or Russia, they're pretty happy with what they've got. Countries like Israel and Saudi Arabia were very uncomfortable with the Obama administration. China can't quite make up its mind. On one hand, the United States has created geopolitical vacuums that China's happy to fill. On the other hand, they find it really hard to figure out an America that's so wildly inconsistent.
Richard, you talked about what it might look under a President Obama if he were to be elected. A President Biden if he were to be reelected. But what would the alternative be? Let's assume we have a second term of President Trump. What does that world look like? And particularly coming back to American prosperity, what might it mean for American prosperity?
David, in my experience, reelected presidents essentially double down. They continue. They feel they've got a mandate for more of the same, or in some cases, just more. So I would think a second term would be very familiar. Alliances would wither. The United States would essentially become unilateral, very aggressively protectionist and bilateral on trade. I think it would be very familiar.
That was Richard Haass, president of the Council on Foreign Relations and author of the best-selling book, The World, A Brief Introduction. Coming up, reviving New York by creating 100,000 new jobs for those who need it most. Explained by the co-chair of the new New York Jobs CEO Council, Accenture CEO Julie Sweet.
This is not charity. This is about opening up the avenues to great talent that's being untapped today.
This is Wall Street Week on Bloomberg.
Big cities, big hits. Metropolitan areas in the U.S. are feeling the economic pain from the pandemic. San Francisco, New York, and Seattle have all seen a drop in online job postings from a year earlier.
I mean, normally the state of New York is very generous in terms of incentivizing businesses from Buffalo to Manhattan. And we understand that that's part of our job is an opportunity for businesses to thrive and create jobs.
As companies including Google, Facebook, and Twitter extend remote work plans through the year end, or even indefinitely, people are leaving San Francisco and Manhattan for the suburbs.
For sure, we're thinking about the office as a different thing. Now that everyone has experienced and loved parts of working at home, we realize that we need to actually have an office as a destination for certain things, not just a place to go and get your work done, because we all know you can get that done at home.
Businesses are shutting down as a result of the pandemic measures, leaving retail real estate struggling. In Manhattan, the shopping hub at Lower Fifth Avenue saw retail asking rents plunge in the second quarter.
Consumer behavior is clearly changing as a result of the pandemic, though, and I think a lot of this is going to stick.
Some still hope the exodus from America's biggest cities is only temporary, rather than a permanent change.
If you're in New York City or any one of the major gateway cities, you don't come to work there so that you can work from your apartment.
Unemployment in urban areas has been hit hard by the pandemic, but especially for those in minority communities, something specifically addressed by a new initiative announced this week by 27 CEOs, the New York Jobs CEO Council, which is committed to creating 100,000 new, well-paying jobs and making sure those in underserved communities have the skills to fill them. We talked about the program with one of the co-chairs, Accenture CEO Julie Sweet.
Before the pandemic, we'd actually come together, and this council has been in formation for some time. The pandemic, of course, has put even more pressure on underserved New Yorkers. And also, very importantly, it's changing the whole jobs picture. You hear about things like digital transformation. You're going to have more automation. There's going to be pressure on jobs and that many underserved New Yorkers might access today. And so it's even more important that we help these communities get to stable, well-paying jobs. And what's so unique about this effort is it's both CEO-led, but you have some of the most important industries for the future, like healthcare, financial services, and technology, well represented, which is critical for those kinds of jobs that we need to create.
We've seen a lot, talked a lot about the growing wealth and income inequality in the country, and many people say that goes back to the question of education and skills. There's a difference sometimes between education and skills, because we tend to think of four-year liberal arts college. What are you going to be doing to prepare these young men and women?
It is important to distinguish between skills and education, because one of the things that we found at Accenture, for example, is that many things that we used to require a four-year degree, we now have apprentices with 2 years degree who are very successfully doing that and then moving on to better jobs. We have 700 apprentices at Accenture currently. And so focusing on what are the demands of the job and what are the skills are critical to opening up more opportunities at companies like those represented on the New York CEO Council. But separately from that, what the council's also doing is working together to make sure that we also serve the particular needs of these communities. Many of the individuals that we'll be serving don't come from families where they've had other people who work in the types of companies represented here. And so we're also partnering with not-for-profit organizations in addition to educational institutions like CUNY to make sure that these individuals have the soft skills and the support they need to succeed at these types of companies.
100,000 jobs sounds like an awful lot. It's over 10 years. At the same time, New York is a very big place. It feels almost like a drop in the bucket, an important drop, but a drop in the bucket. Can this really help move the needle, do you think?
Well, first of all, no one has done something of this scale to date. And so while I agree with you, 100,000 jobs isn't going to be the answer to all of the economic opportunity that needs to be created, it's a first step at a really, truly scaled opportunity. And believe me, with the CEOs on this council, we'll be raising our ambition as we begin to deliver on our commitments.
We have a little thing called a pandemic that has really put that somewhat in question from some people. Again, from your position as CEO of Accenture, you must have some visibility in this. Do you assume that New York City will come back to anything close to the levels it was before the pandemic in terms of working?
New York City is a very important part of our own network of cities. We do have absolute belief that New York City is going to come back, and that with the world's greatest companies here and being major employers and the kind of commitment that you're seeing, I think you see that belief actually expressed in this type of commitment.
Will it look quite different from what it was before, from what you see right now as you advise different companies as your clients? Are they really looking at reconfiguring their workforce, things like more telecommuting, less in the central city?
Whether you're in New York or in virtually every major city around the world, it's going to be affected by the pandemic. We're definitely going to have different kinds of remote working, but also what is difficult to predict today, but what we're seeing with our clients is we're going to have new types of opportunities. And one of my counsel to many of our clients is that it's important to bring people together. And so many who are saying, you know, is this the death of commercial real estate, for example? I don't believe it is, because innovation, while it can be done remotely for a certain amount of time, is really critical to have people, you know, come together.
Julie, this sounds like a wonderful thing, almost eleemosynary. Is this charity, or is this doing something more profound for New York?
David, this is not charity. This is about opening up the avenues to great talent that's being untapped today. Remember, there are more jobs than people to fill them still in New York City. And so we need greater skills, but also, and we've seen this at Accenture, these communities are filled with great talent who just needs the opportunity. And our own experience with apprentices is that they are innovative. They have a great desire to learn. They're committed to the company. They're committed to their community and their colleagues. They are, in short, right, a profile of the types of employees that companies like Accenture and those involved in the council want for the future.
That was Julie Sweet, CEO of Accenture. Coming up, Scott Meinert of Guggenheim gives his views on the markets, on the economy, and on what needs to be done. This is Wall Street Week on Bloomberg.
I think it's quite possible that if the economy remains in a recession, which I think it is, that we could see long-term Treasury rates close to 7% within 12 months.
That was PIMCO's Bill Gross back in 1990. Now, in his heyday, Gross was known as the Bond King. When he retired last year, Gross told Bloomberg that Scott Meinert of Guggenheim could very well be the next Bond King. Of course, Meinert is dealing with more extreme market conditions. So I asked Guggenheim's global CIO about this week's drop in treasuries that pushed up the 10-year yield to 72 basis points, and whether he still believes the market will send U.S. rates below zero.
The seasonality here for bonds turns negative. Traditionally, the bottom in yields for the next couple of months is the second week of August. So the sell-off arrived right on schedule. I'm not surprised, but having said that, you know, we have a pretty good support on bonds and in terms of our 10-year notes, and in terms of getting rates above, let's say, 1%, I don't think that's very likely. There's a lot of deflationary pressure. All the debt piling up out there is essentially deflationary. And our models, which have been reliable for the last 35 years, basically indicate that we should expect that between here and, let's say, the next 18 months or so, that we would see the 10-year note go to negative 0.5% or negative 50 basis points. But the estimate range is between negative 2% and negative 1 or a positive 1. So, you know, we have never missed hitting the target number in the model. And as a matter of fact, we've never failed to overshoot to the lower end. So, you know, I still remain bullish on bonds longer term. They don't represent good value. They give incredibly poor returns, but the pressures in the economy look like they will ultimately turn back to negative, whether it's in the fall because we don't have stimulus packages, or whether it's longer term because we've done some real permanent damage to the economy. Mm-hmm. And it'll take a long time to get everybody back to work.
Okay, that's for the longer term, but in the short term, we are seeing eco data this week that showed increases in prices both on the consumer and the wholesale level. Do you see any sign that fears of deflation are giving way a little bit to expectations of a more sustained increase in prices?
Oh, absolutely. I think that the bounce back in prices sort of caught some people off guard. It's not to be unexpected, because when you have some prices plunge as much as they did, like oil and petroleum products. It's not unusual to see, a bounce back once the economy reaches some level of stability, which it appears we have.
One thing you believe Congress should take up, one measure that they should really consider is a payroll tax cut. But this is a bit of a political quagmire. It's kind of loaded because President Trump has been pushing for something like this even before COVID, and it makes it a little bit politically untenable for a lot of members of Congress. What is your view here on how the administration and Congress should proceed with a payroll tax?
Well, I think first off, the real test sits in the Senate, because the Senate is the place where we could actually get this kind of discussion rationalized. But my view on the payroll tax holiday is it would be stimulative for the economy. It would probably add 2 million jobs to the economy. I'm in favor, though, of a period of a payroll tax holiday, which is voluntary on the part of participants, which in exchange for getting a holiday on the payment of their payroll tax, they agree to extend their retirement age. And when you look at the numbers on this, based upon the proposal that I've shared with Bloomberg's and others, this would free up another $15 to $20 trillion in savings for the federal government, which could, a large portion of that could be used to provide additional stimulus, extended unemployment benefits, stimulus checks, and even an extremely large infrastructure program like $3 trillion. A $3 trillion infrastructure program would not only help get the economy going again, but since state and local governments basically spend most of the infrastructure money, it would help shore up the state and local finances without having the administration to have to compromise on their tough position in terms of helping state and local government.
Okay, so what you're proposing sounds like it could be a win-win. You speak regularly with Fed officials, with folks in Washington. From the Federal Reserve's point of view, and of course they try to remain neutral in all these politics, what would be the main objection to a payroll tax cut?
I think the payroll tax cut that I'm talking about, I think, though I've never directly gotten feedback from them on it, they would see as fiscally responsible. As you know, there are a number of people out there, whether it's the conservatives in Congress or people at the Federal Reserve, which are concerned about the sustainability of deficits in the long run. By doing this, we would reduce our long-run deficits in the United States, and it would help secure the ratings, which are currently being challenged by Fitch and other rating agencies as downgrading the United States government.
I want to get your thoughts also on just the framework that different policymakers and politicians are using when it comes to coming up with solutions for the slowing economy. The pandemic has created a new normal for all of us, a new normal daily routine. To what extent do you see evidence that policymakers and economists are relying on old solutions, the old playbook, rather than creating their own new normal in addressing how to tackle some of these challenges?
Well, just like the financial crisis, Scarlet, one of the major mistakes in the financial crisis was that Washington did not use it as an opportunity to deal with the true structural reforms that were necessary in the economy. And, the famous line that, don't let a good crisis go to waste. There's an opportunity here that Congress can implement big structural reforms, not just my ideas, that could really change America and improve living standards, get rid of income inequality or reduce it, and assure the expansion for a long period of time. The problem is that Congress is focused on getting reelected, and politics have overtaken pragmatism. And there's a phenomenal opportunity sitting in front of Congress and the president to really make permanent, lasting changes to the United States economy, just like Ronald Reagan did.
That was Scott Minerd, Global CIO for Guggenheim Investments. This is Wall Street Week on Bloomberg. This is Bloomberg Wall Street Week. I'm Scarlet Fu, in for David Westin. Retail sales extended their V-shaped recovery in July, but it was a meaningful slowdown from June, and there is lingering pain behind the headline number. Gains in online sales and at grocery stores mask the fact that certain sectors, such as restaurants and bars and clothing outlets, are far from fully recovered. Kelsey Groome, Senior Managing Director of Traub, joins us now. Kelsey, the total value of retail sales bounced back to pre-COVID levels, but the composition of the spending has changed. Consumers are spending on things like appliances, not experiences like restaurants. What can you tell us about this shift in demand? How permanent is it?
Yeah, well, I think we tracked kind of through the course of the pandemic, starting in mid-March with one of our consumer insights partners, very closely the consumer, and clearly we saw a rapid change in behavior, both in category and in what was driving purchasing decisions. I think that, you know, what we see now is that the consumer is spending beyond just essentials. You know, some of the categories that have seen an uptick lately have been beauty and accessories. Fitness has been a big one, in-home entertainment. But I think that, you know, the consumer, as the virus kind of hit and rolled out state by state beyond New York, the consumer is more sensitive to doing some of the, you know, restaurants, bars, et cetera.
Yeah, and right now we're in a pretty critical period for retailers as well, because August usually means back to school shopping. We still don't know what school will look like, and it's not clear whether consumers will spend the way they did before, like in the past. How do you see this playing out?
Yeah, I mean, clearly the most important behavioral shift as the pandemic hit was this massive shift to digital. Both front of house and back of house. And from a consumer perspective, the consumer shifted immediately online. And I think that we'll see back to school spending, you know, those trends will continue to pick up online. I think we will also see, again, a category shift, probably less on apparel for back to school and more on laptops, et cetera.
Now, retailers that offer a digital channel and that invested in that are seeing those investments pay off big time. For those with a physical presence that still rely on that foot traffic, explain how their real estate needs are changing. Will they need less space? Could they need more space to accommodate more people and more social distancing? How will it change in the future?
Yeah, I think in the immediate term, you know, until there's really a vaccine and people are truly out and about and there's a return to normal again, all retailers will be looking at their real estate a bit differently. I think that, you know, one of the main things that has come about during the pandemic is obviously the convenience factor and having inventory as close to the customer as possible. So I think one of the critical elements that the store will play in the immediate future is not just for curbside delivery or buy online pickup in store, but also as many fulfillment centers that are closer to the consumer. I also think that the consumer, you know, has started to show a higher level of comfort in coming back to the store, particularly with brands and retailers that are being very transparent about their policies, and that's helping. Also, the contactlessness is, you know, those contactlessness and the convenience factor, I believe, are here to stay.
Final question to you, Kelsey. Retailers are obviously spending tremendous amounts of money updating their physical stores, making them, again, more spacious to abide by social distancing regulations. This is something we'll get details on from the companies themselves when they host their conference calls. Are these costs something that will be passed on to consumers?
You know, I think the consumer right now is fairly fragile. There's been a huge amount of uncertainty from an economic standpoint and from a health standpoint, obviously. And I think to imply that those costs will be priced in won't necessarily be an immediate one.
What is the single most important insight that you want to hear from these company executives when they do host their earnings conference call? What do you want to know from them?
You know, I think the importance of how nimble they're being with their inventory and digital experiences is really important, and how they are reaching their consumers in their home.
And as the economy recovers, do you expect to hear some of them be able to regain pricing power? Who do you think has pricing power in this kind of environment?
Yeah, you know, I think the usual suspects, which I would call the established old guard, have done an incredible job: Walmart, Target, Amazon. But I think there is also a group here that I would call the innovators in our space, and that is Real, Revolve, Farfetch, and Stitch Fix. And I think those innovators did an incredible job pre-pandemic at establishing loyalty with the customer. I think they've done an incredible job during the pandemic. And I think they will emerge on the other side of this as having retained and earned new loyal customers.
In the meantime, Kelsey, how is the retail industry positioned for the critical holiday shopping season, given what we're going to be seeing during back-to-school shopping?
Yeah, I think the retailers have all done an incredible job at rapidly changing their business models to be able to meet the customer where the customer wants to be met, whether that is picking it up in their car, curbside, or coming in store, or ordering it online. And I think the quicker you can get inventory to people, the better positioned you are.
Kelsey Groome, thank you so much. Senior Managing Director of Traub. We want to get as much information from her as possible, given that retailers begin reporting their earnings next week. That does it for this edition of Wall Street Week. I'm Scarlet Fu in for David Westin. This is Bloomberg.